Welcome, everybody. This is a panel on innovation in payments, so hopefully everybody's in the right place. My name is Dana Stalder. I'm an early stage venture capitalist, spent a lot of time in the payment space, and I spent much of my career actually in the payment space prior to being in venture. Why don't we start off with quick introductions so everybody has context.
Okay.
Paresh?
My name is Paresh Patel, founder and CEO of a company called PayRange, and we do payments to unattended retail like vending, laundry, amusement machines, things like that. And we have a full suite of software that rides along with that. So we do marketing and promotions, data and analytics, inventory data, and all that stuff.
Has anyone heard of Brex before? I'd just like to go. So I'm Larissa. I was employee number 1 of Brex, the first corporate card for startups. And I came to be employee number 1 because I knew the founders, Enrique and Pedro. They had founded the equivalent of Stripe in Brazil. And we met because they were applying to Stanford at the same time I was applying to Harvard. And when they started Brex in 2017, they just thought of me, we connected, and thought it would be a great idea. So I've been through 6 different departments there since. I was the first salesperson, then trained a sales team, first customer support person, and trained our customer experience team. Now I'm mostly focused on marketing and growth and community.
Hi, everyone. My name is Richie Serna, CEO and co-founder of Finix Payments. Got my start in the payments world at a company called Balanced, which was the first payments API for marketplaces. We ended up exiting to Stripe back in 2015. And now at Finix, what we do is we build software for vertically specific SaaS businesses that are looking to bring in payments and monetize on that. So building a lot of the lower level infrastructure for them to focus on those value-added services.
Good. This is great. So we've got a B2C, we've got a B2B model, and we've got an infrastructure model here. So you guys should have good perspectives. So let's start off big picture. If I look back over the last, call it 5 years, there's been a handful of multi-billion-dollar companies built in the payment space. So Stripe and Square come to mind on the merchant acquiring side. Afterpay and Affirm on the credit side. What do you, as you look back and let's just look at the last 5 years, what's the takeaway? Like what's allowed these multi-billion-dollar companies to be built in such a short period of time?
I think at the core, really what these companies are doing, especially when it comes to Stripe and adding Square as well, is they're changing sort of the risk model. If you go the traditional acquirer route, they probably take anywhere between a month to a month and a half to do the merchant underwriting process. What Stripe said was, give us 15 to 20 data points so that we can verify your identity, ensure that you're not on a terrorist watch list, and you can start processing in a matter of minutes instead of that 2-month period. So they opened up the top of the funnel.
Yeah.
Then what they did was, if they saw any of these businesses become fraudulent or have abnormally high chargeback rates, they would shut them down. Same thing with Square.
Yeah.
To add to that, I think that when it comes to building multi-billion-dollar companies, there's 2 main things at play. One is to choose a very big market, and payments and financial services has that potential, but also to know where to start so you don't get lost. So investor of ours from the early days, Peter Thiel, he has a piece of advice that we very much agree with. He says that the best way to build a monopoly is by building a bunch of small monopolies. So, Square started with these small businesses that were taking cash because they didn't want to deal with high fees and with complicated technology. Stripe went after these developers and made something very simple for them that used to be really complicated. And from there, they diversified and they scaled. So we are sort of doing the same thing at Brex. We're starting with a credit card for startups because startups are early adopters. They grow really fast, so give you this potential to grow really fast. And there is less barriers of approval internally. And our goal ultimately is really to become very dominant on the B2B financial services market. And we're doing that by niching and focusing on these smaller spaces first. So we started with startups. Last week, we launched our card for e-commerce. So instead of being a payment method, it's now a way for them to finance their inventory. And from there, we want to also diversify to other products and go upper markets as well.
Yeah.
Yeah, so just to add to what these two said, I think the most obvious, though, is like how they've kind of looked at the processes and everything from onboarding to, setting things up and just using the system. They challenge long-held assumptions in the industry that some of the incumbents just couldn't get past that conventional thinking. And so they kind of challenge a lot of the conventional thinking that was out there, and from the risk model to go to market, but all of that. And it just changed the way business is done there.
Yeah. So there's a couple of themes here. One about just speed and ease of integration and rethinking underwriting models. If we think about the next 5 years, what is the next set of billion-dollar, multi-billion-dollar payment companies to be built? And you can't just answer your company, by the way.
His company as well.
But where is the greenfield, and where can somebody actually build the next $5-10 billion company here?
Yeah. In our view, we're seeing a profound change in terms of the distribution model of payments. I think that right now it's somewhere around 10% of all payments are being distributed through software providers. So if you provide software for a gym, you're not going to go and build your own day-to-day operational management. You're not going to build your own subscription management. You're going to get a full suite of tools to run the day-to-day components of your business, and payments is a piece of that.
Yeah.
You're seeing that in a ton of verticals. We have partners that we work with that just own the mechanic market, those that work in the HVAC business, those that are in pest control. And so they're starting to monetize on these small verticals, but at scale, it becomes massive opportunity for them. So I think it's going to be really around that verticalization.
Yeah. Shopify being a good example, right?
Yeah, I mean, MindBody is the perfect example, where 40% of all their revenue, and I think it might be now up to 55%, is coming from payments.
Yeah.
There's a lot to be done on the skipping the checkout line, which is being led by Amazon. So I think we'll be seeing a lot of stuff there. We should be able to walk into a store, just grab something and leave, and that's a huge opportunity. But we're at the B2B space because it's the one that has had the biggest barriers so far, and therefore also comes with some great opportunities. So there's a lot to be done there as well.
Yeah.
But skipping the checkout line is one of the big, I think.
Yeah, so kind of just related to what she just said, the Federal Reserve estimates that 60% of all cash transactions are actually small ticket transactions, small ticket being $10 and less. And so if you look at it, that is a big space that is still relatively untapped. And so we think a big opportunity is going to be in that small ticket space. But what's going to be interesting is that the consumers are going to need something more than just a payment solution there. We think that it's going to have to be wrapped around a whole different experience. And so you look at things like order ahead, those are better experiences, payment gets wrapped into that. And so what we think is as you start going into the small ticket space, you're going to have to solve for something more than just payment, and payment just becomes a secondary part of the experience that you're actually solving.
Yeah, yeah. I think that's similar to the point you were making around this verticalization and bundling it together with a enterprise SaaS solution. It seems to me one of the key drivers of a lot of the payment innovation over the last several years has been kind of the unbundling of banking services, not just in the merchant acquiring, but how important has that been to enable the businesses you're building?
Yeah, I think everyone probably in this room has seen sort of the unbundling of Wells Fargo or one of the their landing pages, and you're seeing that in terms of the retail side of the bank. You're now seeing that occur in the acquiring side of the bank, where effectively what these companies are doing is building internally a payment processor. Right? They have a direct relationship with the acquirer, who is their sponsorship to do this type of payment, but they are ultimately the ones who are making the decisions of what merchant accounts get underwritten, which ones get created, and then they're monetizing on top of that. And so to do something like that, before you can even go live, you have to prove that you're compliant from an audit perspective, as well as the technical capabilities to manage that entire payment lifecycle. So people always think about payments as just being 16-digit credit card number and an amount, but it's really everything that happens before and after that piece.
Yeah.
And so to build something like that at scale, what we're doing is giving them the tools that you would typically have in-house at a large processor.
there is an aspect of these third parties that allow for that, allow for players who aren't on the, the traditional track of regulation to be able to compete as well. For example, right in the beginning, when we were just getting started, nobody knew what Brex was. We even had a different name. We partnered with Marquera, who was our program manager for our rent-a-bin. And we were able to grow, make our name for ourselves. And today we have our own bin with Emigrant Bank. And that is an important step for us. Also, going beyond those third parties and being able to build this technology in-house to really give us the autonomy, technology-wise, operations-wise, to niche and build those smaller monopolies that we want. So now we sort of skipping this third party is also an important step, but they're great for the beginning.
Right.
Yeah, in our case, I think it's a little bit of a hybrid situation because on one end, on our side of the services we use, we're kind of unbundling what we're using. We're doing our own risk and some of that stuff and the processing. But on the our merchant side, we're kind of simplifying it for them, and we're just selling them a turnkey solution. So they're actually just buying from us kind of everything, and so it's in that sense, it's kind of like everything is just kind of bundled in. But on the other side, we're kind of dealing with it on our separately.
Yeah. It used to be that the payment networks who are obviously the gorillas in the category when you talk about payments, were kind of have a lot of control and laid a lot of friction down with how fintech companies and startup companies worked with them. I think every of the multi-billion-dollar companies I named here that have been built in the last 5 years all have very close relationship with the networks at this point. I'm curious how you guys think about the networks today, the Visa, MasterCards, and their power in this ecosystem, and how you work with them.
Mm-hmm. For us, Visa is actually one of our investors. So we were their first seed investment they've ever made, which was great for us. I think when we were at Balance, we very much viewed ourselves as in strong opposition of the traditional legacy providers, whether that be card networks, acquirers. And I think this time around what we realize is there is a very much a symbiotic relationship. Whether it's renting the bin, we're more so that technology arm. They have the critical infrastructure, they have the compliance pieces that are necessary to make something like this happen, but they don't have the engineering resources to really provide the digital payment experiences that people expect. And that's really where we can come in. So we work a lot with Visa, with MasterCard as well, who want to get their new innovative products out to market, but the old acquirers don't have the development cycles to be able to get them to market fast enough. So, for example, there's a new product that Visa and MasterCard have that's called, it's basically real-time push-to-card. So you can take a debit card, and I can send money to you instantly in 30 minutes or less. One of your companies, Earnin, does that now for payroll. Banks typically deal in notcha files, which is a very old banking sort of spec, and everyone knows the pain of ACH, which is it takes 2 to 3 days for those funds to settle. They're not building payment systems at these banks. They're not innovating on this. And so instead, Visa brings us in, we provide them the software, and then they take it to market. So it's been a great partnership model for us.
Good.
A huge part of Brex is what we did with the technology, building it from scratch. That's what allows us to niche so quickly and to get ahead of the banks, because even if they knew how to do it, it would take them years to really build things from scratch, change their risk structure and their technology. So today we operate through these rails. We operate through Visa, and we operate through now MasterCard World Elite with the new bin. And when we were building this, rebuilding this technology stack from scratch, the only piece that we wouldn't really make sense to rebuild were the networks. So today they still have a massive, massive monopoly on what they're doing. It doesn't really make sense for someone to start from scratch what they're doing. And maybe what I talked about in terms of the checkout, so just walking to a store, like the next payment revolution, maybe it will come from someone who has the entire payment chain integrated. So we'll for sure be experiencing some interesting developments, I think, and I'm curious to see what happens there.
Yeah.
In our case, so we are in the small ticket space, and to some extent, our opportunity exists because of the Visa MasterCard interchange rules and how expensive they are to process small transactions. If you need to top off a dryer, it could be 25 cents, but you can't pay 22 cents to do a 25-cent transaction. So those types of opportunities for us exist because of that. Not to say we're dependent on that, but today our solution is a wallet type solution where you're pre-funding it, and then the users make a number of transactions off that wallet for those small ticket space. But so when I was talking earlier about some of the fundamental assumptions held by incumbents, I think this area is one that's going to be challenging for Visa and MasterCard because they also see that small ticket space as an opportunity, but the banks have a hard time getting past a percentage plus a fixed cost per transaction, which is what's causing those small tickets to be very expensive.
Yeah. What do you think the future of ACH is? I mean, that's really one of the major payment networks that I didn't mention, but obviously manages trillions of dollars of payment volume.
I think it's going to be a part of the financial system for the foreseeable future, especially for B2B payments where they don't want to pay, the interchange rates and it's just too expensive. That said, I think there's definitely a shift now from consumer expectations that they want real-time payments, right? Even with the new rollouts of ACH, they're doing same-day ACH, which basically you can send, it's all batch process, right? So you can send up to 5 times a day, and they will process that transaction that same day, but you have to get it in before 5 p.m. So there's still cutoffs, and it's not open during federal banking holidays. It's not open during the weekends. There's just still so many critical restrictions for that platform that for the next wave of innovation in payment companies, it's going to get, I think people are going to expect a different type of user experience.
Yeah.
Yeah, one of the things that we're trying to do as we move upper market is to give these companies a tool through a credit card with higher limits, and part of our underwriting model allows for these higher limits to sort of skip invoices and ACHs and put these very large transactions that were unthinkable on the card. That's one of the things that we want to do, and we're betting on better integrations with the accounting software, on the real-time need that is a real one, and less fees as well. And
Is the card interchange rates a barrier to achieving that?
It is, but we are we're coming up with some different models with no fees that we cannot through the same rails achieve. But I can't get into too much detail there, but that's definitely.
You think there's room for innovation there?
Considering, yes.
Yeah.
I think from my perspective, the way I look at it is fundamentally it's going to come to a function of speed and cost. So ACH, if it remains batch and it's somewhat slower, it's going to have to be a lot cheaper than the push to card and some of the other ways to come at it. And if those other methods start to leverage their convenience of being real time and start charging more, then it will widen the opportunity. But I think it will still always have a role for things like B2B and maybe even payroll and stuff like that.
Yeah.
I think another good point about that is that ACH is restricted to the U.S. The card networks, one of the tremendous amount of value that Visa and MasterCard can provide. Exactly. And so what we're able to also do now is do real-time payments to international issued cards.
Yeah.
So we can send money from the U.S. to a cardholder in Costa Rica in 30 minutes or less. For much cheaper.
Oh, sorry.
Oh, yeah, go ahead.
No, one quick note on that also is that the interchange today is not really felt by the end user, the person using the card. It's paid by the merchant. So of course we would have some acceptance, maybe resistance there, but we can push through like consumer demand. That's one of the approaches to it.
Let's talk about risk for a minute. It's I spent a number of years at PayPal, and it was, I often describe PayPal as we're actually a risk management company, not a payment company. And it was kind of the least understood attribute. And I think that's generally true of most payment companies, is that their core trust and risk management is the key intellectual property they have. I'm curious what role risk is in your business, risk management is in your business, if at all. And if so, how do you build real intellectual property there?
So for us, we're purely a software vendor. So we give our companies the tools that are necessary to manage risk. They can basically take as much risk and make those decisions on their own. I think there's really two pieces, especially when you look at payment risk. There's the transactional fraud risk, did someone steal this credit card? And then the ongoing risk of the merchant and your portfolio.
Yeah.
What you don't want to happen is, a fire festival, you're their acquirer, and then they have $20 million worth of chargebacks for a festival that never happened, right? So trying to manage both of those are different functions, and there's a lot of people who are really targeting the transactional fraud piece, but not the ongoing risk management. And so for us, we see that these new vertical SaaS businesses are becoming payment businesses, but they don't know anything about the underpinning risk models. And so how can we empower them? Because there's not going to be suddenly a wave of new underwriters that kind of come out of nowhere, right? Payments is incredibly esoteric. So I think that's how we solve it, is going to be through software.
70% of startups that get approved at Brex today do so instantly. So it's a 10-minute application process. On average, 70% of these get their card active and ready to use, so a virtual card and then a physical one arriving 2 days later, on average on 12 minutes. And we're only able to do that because we control risk and KYC in-house. So that's also a huge part of what we do. Of course, we started in a business where we put some requirements so that these startups, they need to be venture-backed, right? They need to be professionally invested. They need to have at least $50,000 in their bank account, and we underwrite based on their cash balance. But having that in-house took way longer, but today gives us this wow factor of being approved instantly, which, in the banks, it can take a very long application process, and then days, sometimes weeks to process. So that has been a core part of what we built as well.
Yeah, in our business, the risk profiles are highly specialized. How somebody uses a vending machine is very different from a washer or a video game arcade. And so give you a simple example, like if you buy 10 Doritos in an hour, that's probably something fishy going on. But if you play 10 video games in an hour, that's probably okay. And so you can't just do transaction counts and amounts and stuff like that. So we've had to build a lot of our own risk heuristics for that. But that being said, generally speaking, our risk is more often than not friendly fraud. Kid takes mom's card, stuff like that. It's less likely that if you actually stole somebody's card, you're going to go do laundry. I mean, that's not the case.
Yeah. How do you guys think about the biggest barriers for you over the course of the next few years in building your business, and what are the challenges that you most face building a payment company and innovating in this area, and what could you wave a magic wand and change to grow faster?
Engineers. It's always a challenge.
Talent.
Yeah, I mean, I think especially for payments, you can have a really great engineer, but if you don't understand the fundamentals of how money moves through systems, of accounting, things like that, it's very difficult to build these platforms. And even very early on, when we talked to a lot of our early partners, they tried building some of these tools in-house, and then they gave up 2 years later because they realized they didn't know anything about payments. It's hard to kind of get that education without working at a payments company first and building it really from the ground up.
Yeah, there's two for us. One is definitely talent. We got this far. Still a lot to do, but we got this far in 2 years by hiring the right people and being willing to pay the price, equity-wise, salary-wise. We don't really believe on the startup theory of, cuts in paycheck and compensation. We are willing to pay for those people, those partners that will help us get there. And when you're there, 5x versus 10x shouldn't really matter. But we're growing at a pace where we're onboarding 10, 20 people per week. And we need to. We are understaffed in every single area. So one of the big challenges is to grow at this pace while keeping the culture very consistent and the quality very consistent until, 3 months ago even, the founders would interview every single person that joined the company, and today that's not possible anymore. So how can we put processes in place to still have that due diligence and move on with that? The second one is to always be paranoid about competition and how we can keep that going, even when there is this sense that we are already there, just because, in a year and a half, 3 rounds, billion-dollar valuation, and not confusing fundraising with success, with being there, how to keep the team paranoid and moving and working really hard. These are the two things that we like to think about.
Yeah, from our side, I would say a big challenge for us is on the customer side, getting to the tipping point. Our customers, our industries are very traditional, very conventional, very risk averse, and the sales cycles tend to be long. But I firmly believe that there's going to be a point when enough traction or enough customers have moved or enough machines have been over there where then everybody else, the whole reason they're not getting there right now is because they don't want to think about it. But once we get there and it becomes a point, the tipping point, then they're not really going to think about it either, and they're just going to roll it out. And so making sure we can get to that tipping point relatively quickly is a big challenge.
Terrific. Well, we're out of time. Thank you guys for joining me up here, and thanks for everybody for coming and sitting in with us.
Thank you.
Thank you.